Okay, so in this chapter, we're going to discuss essentially bonds. And we looked at, in the previous chapter, we talked about various types of liabilities. We talked about payroll related liabilities, short term and long term installment notes, warranties, contingent liabilities, all sorts of stuff. And so rather than complicate the issue even further by adding one more item, we're going to address bonds as a liability, and we're going to give it a chapter all its own because the issue of bonds payable can be, for some companies, quite a large and complex liability, so that the accounting and the financial statement presentation is somewhat complicated. But we'll try to keep things as simple as possible. So let's see what we have here for learning objectives. We're going to first learn a little bit about characteristics of bonds and terminology that are related to bonds payable. We're also going to talk about how do we account for bonds payable. What we're talking about here is how do we record transactions when a company decides to issue a bond. We'll get into that. And then finally, when we think about the financial statement presentation, specifically the balance sheet, how do we go about doing that? Because we're going to find out in limited detail that it's not completely straightforward, but I do think that it will be simple enough that you can grasp it. Okay, so the nature of bonds payable. So a little bit of good news here. It says that a bond is a form of interest-bearing note. And so when we talk about an interest-bearing note, if we recall just to the chapter before this one, we had some short-term notes payable where we had to account for the fact that we were borrowing for less than 1 year. And then we also looked at some long-term installment notes as well, and we got into carrying amounts. And so there's going to be some similarities between those long-term installment notes and bonds. I want to be very clear. You can go to the bank and you can borrow money, and we call that, again, a note payable. But oftentimes companies, particularly of larger size, publicly traded companies, on the stock market and so forth, will raise money by selling bonds to investors. And those investors become creditors of the company, much the same way that a bank would if you went in and borrowed money. So it says, like a note, a bond requires periodic interest payments. And then with the face amount of the bond to be repaid at maturity. So, if you were to go out and buy bonds for, say, $10,000, you're going to get a periodic interest payment, and then at the end of the period, or at the maturity date, you're going to get your $10,000 back. Other information: if you own bonds, if you're a bondholder, you are a creditor of the corporation that sold you those bonds. Now, you don't own any part of the corporation, but this is important information to consider. It says, as creditors of the corporation, bondholder claims on the corporation's assets rank ahead of stockholders. Okay, stockholders are owners, bondholders are creditors. Okay, so in the event that the corporation were to have to file for bankruptcy and liquidate assets, bondholders have a stronger position in the event that a company is liquidated. Now, we should also probably mention stockholders have a much stronger potential for gains if the company is doing well, stockholders make a whole lot more money than bondholders. So bondholders or owning bonds is a bit of a conservative investment move, assuming that the company that you're investing in is solid. So a little bit of terminology and characteristics of bonds. If you were to, I gave the example, if you were to buy $10,000 worth of bonds, you would probably actually own 10 of those. $10,000 divided by $1,000 bond increments, which is usually how bonds are issued. You would have 10 bonds. So what a company might do is they'll say, okay, we need to raise $50 million, and we're going to go out and we're going to try to sell these off to professional investors. And then if there's any left over, we're going to sell those in $1,000 increments to individual investors. So again, we talked about this. The principal, however many of these $1,000 bonds we own, whether it's 1, 10, or 100, the principal on these must be repaid on the date or dates that the bonds mature. Some bonds mature on more than one date. Okay, so we talked a little bit on the previous slide about interest. Well, interest is how we make our money when we invest in a bond. If we buy one bond for $1,000, we're going to ultimately get back $1,000. So our only way that we can make any profit is on interest. And so the interest on bonds, it says may be payable annually, semi-annually, or quarterly. I went ahead and bolded semi-annually, that is roughly every 6 months, because that is the most common thing that you'll see. A little bit of vocabulary here. The underlying contract between the company issuing the bonds, which is actually the debtor, and the bondholders, the creditors, is called a bond indenture. So when we see bond indenture, we need to associate that with a formal contract. Says here that the two most common types of bonds are term bonds and serial bonds, and between these two, term bonds are going to be the most common. And so we talked about a company issues $50 million in bonds, and let's just say that they issue those on February 1st of year 1, and those are going to mature January 31st of year 10 or year 9, whatever the case may be. We call these term bonds. A 10-year bond would be called a term bond. If the bonds mature over several dates, they're called serial bonds. So think about a serial number. A product is made, it has a serial number, the next one is made, it's the next sequential number, more than likely. Serial bonds are attractive to investors because of this maturing at several different dates. It is a more flexible investments. There are also bonds that are convertible, what we call convertible bonds. These can be converted from bonds, which are a form of debt financing, where the holder of the bonds is a creditor of the company. But a convertible bond can actually be exchanged for stock. And now your example here says common stock, but it could be common stock or preferred stock. We haven't learned about stock just yet. So this gives a convertible bond gives the holder the option of remaining a creditor or converting to stock ownership, i.e. there would no longer be a creditor of the company, they would be an owner of the company. And again, we'll get to stock more in the next chapter. Bonds that may be redeemed by the corporation prior to maturity are called callable bonds. And corporations do this whenever they usually will, in the bond indenture, they will put a provision in that contract that says we reserve the right to pay you off early. And the reason that companies do this is because they understand that if they issue bonds at 5% and then the interest rate goes down to 4.5 and 4 and 3.5, they're paying way too much interest. So they need to extinguish that debt, and then if necessary, reissue those bonds at a lower interest rate, so they're not paying so much interest. So just a kind of a side note, a term bond, for example, that lasts for 10 years might also be a callable bond. Okay. We have some other types of bonds here. Zero interest bonds pay implicit interest, meaning you might pay $700 for the bond, and then upon maturity you get $1,000, and that might take 10 years. Well, you're not getting any interest payments. The interest is implicit. It is implied because you're paying so much less for the bond than the face value. Bearer bonds can be redeemed by the bearer of the bond. Now these are highly negotiable, but whoever has the bond has full rights to those bonds. So we don't want to lose these. Okay. Registered bonds are the exact opposite. These bonds belong to a registered owner. So if you leave behind 10 of your registered bonds and I find them, well, they're registered to you, so I can't do anything with them. And then commodity-backed bonds, we're not going to get into that. So moving right along, proceeds from issuing bonds. It says when a corporation issues bonds, the proceeds received for the bonds depend upon the face amount of the bonds. Okay. If it's a $1,000 bond, you're going to get somewhere around $1,000. Now I say around, but we'll get to that in a moment. And here we are, the interest rate on the bonds and the market rate of interest for similar bonds. This is a complicated little concept here. You would think that if we had a bond that was $1,000 and we sold it, that we would get $1,000. However, we're going to figure out that the stated interest rate on the face of the bonds as it compares to the market rate of interest that is being paid on similar bonds issued by other companies will actually enable us to get, again, using the example of a $1,000 bond, either a little bit more than $1,000 or potentially less than $1,000. But again, we will get into that shortly. It says here the face amount and interest rate on the bonds are identified in the bond indenture. So this is part of your contract. It'll state the interest rate in the contract. This information will also be available on the face of the bond because a bond is a physical document. The interest rate to be paid on the face amount of the bond is called the contract rate or the coupon rate. Now, if we're not dealing with bonds, oftentimes we will say that a synonym for the interest rate is the discount rate. But we're going to find out there's a reason why with bonds we don't use the word discount rate. We use either the interest rate or preferably what is most commonly referred to as the contract rate, because again, remember, the interest rate is identified in the bond indenture, which is in fact a contract, sometimes also called a coupon rate. The market rate of interest, it says, sometimes called the effective rate of interest, is the rate determined from sales and purchases of similar bonds. And why this is important is we need to understand that when we, as a company, we decide that we're going to issue bonds, this is a fairly long and drawn out process. And again, these are physical documents. So, it is very, very possible that we could have bonds printed up with a certain contract rate on those. And by the time we actually go to sell those bonds, the market rate of interest has changed. And when I say there's a very good chance that this will happen, by a very good chance, I mean 100% or 99.9. The chances that that the that the contract rate is going to match the market rate of interest is pretty slim. So when we compare the market rate of interest to what we have on the contract, we have to make adjustments up or down to the bond price. And to illustrate that a little bit here, when we compare the market rate of interest and the contract rate of interest, what we find is this. It says here, when interest rates fall, bond prices rise. Okay? And I want you to think about why this would be true. The interest rate in the market is going down. Well, what that means is that our bond has a higher interest rate than what the market is paying. So if you buy our bond, you're getting a really good deal, so we can sell you the bond for more. Bond prices go up. However, when interest rates in the market are going up, our bond price goes down. Because if we initially, just say for example, we initially issued our bonds to pay 5% interest, and now interest rates for similar bonds are paying 5.6%, a little over 5.5%, well, you can get a better deal on other people's bonds, so we have to adjust our prices downward to make up for the difference. So here's a little, a very helpful slide. I'm not going to go through all of it, but I do want to tell you that most of the time we will sell a bond at either what's called a discount or at a premium. Selling the bond at the face amount, in other words, a $1,000 bond sells for $1,000. This is very difficult to achieve. The market rate of interest matches the contract rate stated on the bond. This almost never happens. Okay? In reality, either the market rate is going to exceed the contract rate, which means we have to sell our bond for less, or the contract rate is going to exceed the market rate of interest, okay, and we can get more than 1,000. So market rate of interest, pretty easy to understand. That's the interest rate out on the open market. The contract rate, again, this applies specifically to the bonds that we're trying to sell. And we pretty much just went over all of that. But here we have, on the previous slide, we had kind of a diagram. On this slide, we have some text to basically describe the exact same things that we talked about on the previous slide. Okay? So a little bit of terminology here. It says, again, under proceeds from issuing bonds, the price of a bond is quoted as a percentage of the bond's face value. So it gives us an example here. It says, for example, if we have a $1,000 bond that is quoted for sale at 98, that bond could be purchased or sold for $980. How did we get that? We took the 1,000, we converted this 98 to a decimal, and we multiplied the 2. So this is a situation where the market rate of interest exceeds the contract rate. Not by much, but we have to sell our bond for a little bit less to make up for the fact that the investor is not getting quite as much interest. Here we have a situation that says, likewise, bonds quoted at 109 could be purchased or sold for 1,090. 1,000 times 1.09 or 109%. These are said to be bonds that have been issued at a premium. So the coupon rate is far higher in this case than the prevailing interest rate. We go to sell the bonds, interest rates go plummet suddenly, and all of a sudden we have a bond that is paying too much interest. Well, to make up for that, we have to add to the price. We have to sell it for 1,090 because we're paying you too much interest. By you paying us $90 more up front, that helps offset the fact that we're going to be paying you slightly too much interest over the term, there's that word again, of the bond. All right, this video is getting really long, so we're going to stop it and move on to another one.